Hello everyone, welcome to the March 16 Monday edition of Market Opening Bell, your 10-minute guide to the stock market. Hong Kong stocks closed mixed but softer last Friday. The Hang Seng Index opened 133 points lower, narrowed its morning losses to just 19 points at 25,697, then widened again to 296 points at 25,419 before finishing the day down 251 points or 1% at 25,465. The H-share index fell 28 points or 0.3% to close at 8,671, while the Hang Seng Tech Index dropped 49 points or 1% to 4,978. Total market turnover reached 246.5 billion Hong Kong dollars. Southbound trading volume total $116.295 billion, with southbound funds recording a net inflow of $18.449 billion. The main net purchases were $7.984 billion in the Tracker Fund, $2.827 billion in the Hang Seng China Enterprises Index ETF, $1.063 billion in Tencent, $976 million in the CSOP Hang Seng Tech Index ETF, $760 million in Sino, $357 million in Smart, $294 million in Alibaba, and $100 million in Yangtze Optical Fiber and Cable. The only notable net sale was $240 million in Hua Hong Semiconductor. Statistics show that southbound funds have now bought Sino on a net basis for 3 consecutive days, totaling 3.037 billion Hong Kong dollars. For the week, the Hang Seng Index fell 291 points or 1.1%. The H-share Index rose 43 points or 0.5%, and the Hang Seng Tech Index gained 30 points or 0.6%. Southbound funds recorded a net inflow of 33.991 billion for the week after a net outflow of 8.094 billion the previous week. Technically, the Hang Seng Index has filled the upward gap between 25,442 and 25,611 points. It now has a high chance of retesting the 250-day moving average at 25,067 and even the 25,000 psychological level. On the mainland, Shanghai and Shenzhen stocks also moved lower last Friday. The Shanghai Composite lost the 4,100 level to close at 4,095, down 33 points at 0.8%. The Shenzhen Component Index closed at 14,280, down 94 points or 0.7%, while the Chinex Index finished at 3,310, down 7 points or 0.2%. For the full week, the Shanghai Composite fell 0.7%, the Shenzhen Component rose 0.8%, and the Chinex gained 2.5%. The onshore yuan central parity rate was fixed at 6.9007 against the US dollar, 48 pips weaker. The People's Bank of China announced that new yuan loans in the first 2 months of the year total 5.61 trillion yuan. February's new loans came in at 900 billion yuan, sharply lower than January's 4.71 trillion, but above the 860 billion expected by some economists. Regulators continue to guide banks away from window dressing lending, aiming for a more even distribution of credit throughout the year. On the corporate side, policy-driven structural tools remain supportive, with high-tech and strategic projects still the main focus of lending. Household demand stays weak, and medium to long-term loans, mainly mortgages, contracted, indicating the property market still bottoming out. Meanwhile, total social financing in the first 2 months reached 9.6 trillion yuan, 316.2 billion, more than a year ago, and beating the market forecast of 9.25 trillion. February's social financing increment was 2.38 trillion, also above expectations. Broad money supply M2 grew 9% year-on-year, unchanged from the previous month and slightly above the 8.8% consensus. Narrow money M1 rose 5.9%, a clear rebound from January's 4.9%, suggesting improved corporate liquidity. Overall, the first 2 months of 2026 shows steady and balanced financial aggregates. Although February was seasonally softer because of the Lunar New Year holiday, both social financing and credit growth stayed within a reasonable range, confirming that the moderately loose monetary policy is continuing. In the United States, another financial institution has restricted redemptions from private credit funds, sending HSBC holding shares down nearly 5% to close at $122.5 and Standard Chartered down 5.1% to $164.5. Reports indicate growing market concerns over the quality of private fund loans, especially those to software companies threatened by artificial intelligence. Although most funds had earlier tried to meet withdrawal requests, BlackRock decided last week to limit redemptions, and other asset managers followed. Banks' direct exposure to private credit is actually relatively limited, but the market is clearly adopting a self-us ask questions later stance. Swire Pacific plans to sell 2.52% of Cathay Pacific shares via a discounted placement, raising a net $1.79 billion. After the sale, Swire will hold 2.797 billion Cathay shares, representing about 45.12% of the issued capital. Swire will receive net proceeds of $1.789 billion and record a disposal gain of $365 million. Cathay Pacific shares fell 5.1%, while Swire Pacific A shares rose 3.1%. Reports say Cheung Kong Infrastructure is seeking a £1 billion bridge loan to fund the acquisition of Macquarie Group's UK smart meter assets. Macquarie's Commodities and Global Markets division is inviting potential buyers, including Cheung Kong Infrastructure, to bid for its gas and electricity smart meter portfolio. In September 2025, Macquarie completed the purchase of Iberdrola's UK meter business for about £900 million, covering 2.7 million meters. In February 2026, Macquarie Asset Management announced the acquisition of Energy Assets Group, which owns 1.8 million smart meters and 148,000 grid connection points. Once these deals close, Macquarie will manage more than 30 million meters across the UK, making it one of the largest independent smart meter providers. The UK government has set the target for the vast majority of consumers to benefit from smart meters by the end of 2030. Smart meters generate stable cash flows through rental income, perfectly matching the long-term return requirements of infrastructure investors. Miniso announced that full-year 2025 revenue is expected to be between 21.44 billion and 21.445 billion yuan, up 26% year-on-year. Full-year profit is forecast at 1.32 billion to 1.33 billion yuan, compared with 2.635 billion yuan last year. The decline is mainly due to an expected net loss of about 2.1 billion yuan at Yonghui Superstores, resulting in an equity-accounted loss of roughly 740 million yuan for Miniso. Additional drags include the 150 to 160 million yuan loss from changes in the carrying value of redemption liabilities on Top Toy's preferred shares and about 192 million yuan in interest expenses from stock-linked securities. In the United States, January core PCE matched expectations, but the ongoing Iran conflict kept oil prices volatile and rising. U.S. stocks rose early, then fell on Friday. The fear gauge VIX edged down 0.1 point or 0.4% to 27.19. The Dow Jones Industrial Average climbed as much as 446 points or 1%, but reversed to close 119 points lower or 0.3% at 46,558, marking a fourth straight losing day. The Nasdaq fell 206 points or 0.9% to 22,105, while the S&P 500 lost 40 points or 0.6% to 6,632, now 5% off its recent high. The Nasdaq China Golden Dragon Index, tracking Chinese stocks, rose 53 points or 0.8% to 7,148. Hong Kong stock ADRs point to the Hang Seng Index opening about 1 point higher today at 25,467. For the week, the S&P 500 fell 1.6%, the Nasdaq dropped 1.3%, and the Dow lost about 2%. Big tech stocks weakened. Apple fell 2.2%. Microsoft and Nvidia each dropped more than 1%. Tesla and Alphabet lost less than 1%, and Meta tumbled 3.8% after its latest AI model reportedly lacked Google's Gemini 3, pushing the release to as late as May. Adobe beat earnings expectations but fell 7.6% after its CEO announced he would step down. Micron bucked the trend and rose 5%. The U.S. economy expanded at an annualized 0.7% in the fourth quarter of last year, the weakest performance since the contraction in the first quarter of 2025. The figure reflects downward revisions to exports, consumer spending, government spending, and investment, while the drop in imports was smaller than previously estimated. U.S. January personal consumption expenditure (PCE) price index rose 0.3% month-on-month, below December's 0.4%, and in line with expectations. For core PCE rose 0.4% month-on-month, matching the previous month's 10-month high. Year-on-year, January PCE climbed 2.8% and core PCE 3.1%. The University of Michigan Consumer Sentiment Index fell to 55.5 in March from 56.6 in February, slightly above the expected 55 and the lowest this year, as households reacted to the military conflict between the U.S. and Iran. Rising gasoline prices had the most immediate impact on consumers, although broader pass-through to other prices remains uncertain. One-year inflation expectations held steady at 3.4%, ending 6 months of declines, while long-term expectations dipped slightly from 3.3% to 3.2%. U.S. job openings rose to 6.946 million in January from the previous month's more than 5-year low of 6.55 million, beating the 6.7 million consensus. Even so, the level remains well below the average since the labor market recovered from the pandemic, indicating that hiring activity is still slow. This week, the U.S. market has 5 key things to watch. First, the Middle East situation and oil prices. Second, the Federal Reserve's rate decision meeting on March 18th and 19th, where no change is expected, but investors will focus on Chair Powell's comments on the economy, inflation, interest rates, oil prices, and tariffs, plus the latest dot plot and summary of economic projections. Third, Nvidia's GTC conference from March 16 to 19, where the company is expected to unveil its new Feynman chip architecture, the first using TSMC's A16 process, centering on agentic AI, physical AI, AI factories, and AI inference. Fourth, economic data including February producer price index, industrial production, January factory orders, and new home sales. Fifth, corporate earnings from Micron, FedEx, Lululemon, and Macy's. Our stock pick today is Goldwind Science Technology, stock code 2208. As the global leader in wind turbine manufacturing, Goldwind Science Technology has drawn significant market attention due to favorable overseas policies and gains from its cross-sector investments. Starting April 1st to 6th, the UK will eliminate import tariffs on 33 wind power components such as blades and cables, reducing the tariff rate from 2% to 6% to 0%. This will substantially lower the overseas cost for Chinese wind power components. The EU is accelerating its energy transition, creating additional market opportunities in Europe for Chinese wind turbine manufacturers with strong scale advantages. As one of the earliest Chinese wind power companies to expand internationally, Goldwind has established a global 1+1+6 R&D layout, along with 7 regional centers, 5 global solution factories, and 3 international production bases. Its overseas business has successfully penetrated markets across North America, Oceania, Europe, Asia, South America, and Africa, giving it comprehensive capabilities to deliver stable and reliable renewable energy solutions worldwide. To date, the company's operations span 6 continents and 47 countries. Its installed capacity has exceeded 2 gigawatts in both Asia, excluding China, and South America, and over 10 gigawatts each in North America, Africa, and Oceania. In the first 3 quarters of 2025, Goldwind recorded operating revenue of 48.146 billion yuan, representing a year-on-year increase of 34.34%. Net profit attributable to shareholders reached 2.584 billion yuan, up 44.21% year-on-year. From January to September 2025, the company achieved external sales of 18,449.7 megawatt, a year-on-year surge of 90.01%. Of this, units of 6 megawatt and above accounted for 15,877.15 megawatt, or 86.06% of total sales. As of September 30, 2025, the company's total external pending orders stood at 38,861.14 megawatt, consisting of under 4 megawatt 605.12 megawatt, 4 megawatt to 6 megawatt 6,596.23 megawatt, 6 megawatt and above 31,659.79 megawatt. External bid won but unsigned orders total 11,012.73 megawatt, including 1,119.8 megawatt for 4 to 6 megawatt units and 9,892.93 megawatt for 6 megawatt plus units. Total external orders in hand reached 49,873.87 megawatt, of which overseas orders accounted for 7,161.72 megawatt. In addition, there were 2,586.97 megawatt of internal orders. Overall orders in hand total 52,460.84 megawatt, representing an 18.48% year-on-year increase. The Global Wind Energy Council (GWEC) releases Global Offshore Wind Report 2025, forecasting that global new offshore wind installations will exceed 350 gigawatt over the next decade, from 2025 to 2034. By the end of 2034, cumulative global offshore wind capacity is projected to surpass 441 gigawatt. GWEC further noted that China's new offshore wind installations from 2025 to 2030 will total 80 gigawatt, accounting for 51% of global new offshore wind capacity during that period. On the cross-sector investment front, Blue Aerospace, in which the company invested 8 years ago, has received approval for its Star Market IPO application. The book value of this investment is expected to appreciate by more than 50 times. Recommendation: buy at 16.2 Hong Kong dollars. Target price $18. Stop loss at $15.30. I do not hold the above stock.